Thank you for joining me. It is Wednesday, March the 8th, 2017. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscriber reports on our online MATA SII site so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals, in the intermediate term risk, and in the short term confidence and sentiment. This month, I'd like to cover some observations I have regarding the divergent views of the equity and bond markets, concerns about stagflation, and a very real possibility of a potential U.S. recession within the next 12 months. Concerning the equity and bond market, the question is, why are we getting such diverging and maddening market messages from the equity and bond markets? Which one is right? And in fact, are either right? Let's consider the perceptions of each of these individual markets. Let's start with the equity markets. The equity market perceives Trumponomic policy will be successful and are aggressively now pricing it in. The level of excitement has now reached the levels that can safely be categorized as simply euphoric. On the other hand, the bond market, the perception there is one of reality, and that is reality of whether Trump's policies will actually be implemented and within expected time frames investors mistakenly believe will happen, potentially mistakenly believe maybe that's true. The level of concern here can be safely categorized as extremely cautious or just simply cautious. Maybe the real underlying questions that need to be answered by thoughtful investors are the following. What exactly are the details of the Trumponomic policies? We have a lot of populist rhetoric, but as yet we have little tangible detailed substance. The devil always lies in the details. Second, if in fact these policies can actually be implemented based on a clearly hostile Democratic Party, as well as significant conflict within the GOP itself from staunch fiscal conservative members and the Tea Party advocates. Third, when will these policies be implemented is simply a major unknown. There is a congressional sequence that must be followed so that an encompassing congressional budget can be passed. The reinstatement on March the 15th of the fiscal debt ceiling is not a small hurdle to be overcome, nor the creative ways the Democratic Party will no doubt do everything in its power or their power to derail and slow any implementation of anything. Fourth, results. Results are a major unknown. Are these policies actually sound? The fiscal stimulus, the tax cuts, regulatory reductions all play very well as populist policies and did work in actual fact during the Reagan administration. But will they actually work today? Or maybe one won't or a couple won't. Many, including Reagan's OMB director David Stockman, in fact, are on the wire vehemently saying they're just misplaced and won't work. Let me categorically state that in no way am I trying to be critical of the Trump administration and their policies here. I am simply, in an unbiased fashion, trying to understand the competing views and which ones are possibly flawed or which ones are maybe closer to the truth. I would suggest that people's political bias is presently clouding their investment thinking. If they're pro-Trump, they're one way. If they're pro-Democratic or anti-Trump, they're clearly the other side. That shouldn't be the case. We should be looking at the facts, the policies, as a standalone, irrelevant of the leadership. To assess who is likely right, we might additionally segment who we are talking about with these views. We mustn't forget that there are two sides to the equity market. There's the sell side. Then the sell side is the Wall Street brokerage houses selling securities and transactions for volumes. They're fund managers wanting to attract more assets under management. On the other side, there's the buy side. These are institutions who do their own research and are not in the habit of disclosing their investment strategies. They buy securities. They're not selling them. They're private funds, they're high net worth individuals who study closely metrics such as flows, volumes, divergences, macro, sentiment, etc., etc. They're very unemotional because they've got to be right. It's not somebody else's money. It's effectively their money or a fiduciary responsibility with that money. The public has visibility to the sell side primarily because it dominates the media in an attempt to sell its products. The buy side, on the other hand, seldom wants to disclose its investment thinking and is not typically found talking on CNBC. My discussions with the buy side with respect to the equity markets, they're presently in the bond market camp. They point out the concerns with the global landscape that few are paying too much attention to, at least currently. Trying to draw a conclusion here. Do we really need to know more to assess who is likely right? Is it those who have unemotionally studied the situation, or those who have faith, believe, and are simply afraid to miss out? A proven strategy has always been, in situations like this, to be fearful when most aren't, and be bold when most are fearful. We presently have both. Who you favor may make all the difference to your financial health here. I've seen this rodeo simply once too many, and sometimes just basic analytics, if you're willing to stay with them, always tell you what will happen. Maybe not as soon as you think it will happen. It always goes on longer, but it's better to be out early than out too late. It's better to give up the last 5% than lose the 20 or 25% that comes. It's that first and last 5% that's always the most expensive. Let's shift gears here for a second now and talk about stagflation and whether it's in fact stalking here. Stagflation, for those that aren't familiar, because it's been a while since we've seen it, or at least found ourselves discussing it, is, and I quote, is a persistent high inflation combined with high unemployment and stagnant demand in a country's economy. Stagflation is very costly and difficult to eradicate once it starts, both in social terms and in budget deficit. It is a situation in which the inflation rate is high, the economic growth rate slow, and unemployment remains steadily high. It raises a dilemma for economic policy, since actions designed to lower inflation may exacerbate unemployment and vice versa. Historically, inflation and recession were regarded as mutually exclusive at one time, the relationship between the two being described by the Phillips curve. Economists offer two principal explanations for why stagflation occurs. First, stagflation can result when the productive capacity of an economy is reduced by unfavorable supply shock that causes an increase in the price of oil, for example, to an oil importing country. And that's what we saw in the 70s, in which triggered the stagflation that was so well known and rampant in the 70s. Such an unfavorable supply shock tends to raise prices at the same time that it slows the economy by making production more costly and less profitable. Milton Friedman famously described this situation as too much money chasing too few goods. I don't think we have a shock here. Maybe it's from too much money. We certainly have too much money right now. Second, both stagflation and inflation can result from inappropriate macroeconomic policies. Now I think we're getting closer to the issue here. For example, central banks can cause inflation by allowing excess growth of money supply. I think that sounds familiar. And the government can cause stagflation by excessive regulations of goods and markets and labor markets. I think we've seen that. Certainly Trump's saying that's the issue, or one of the major issues. Excessive growth of the money supply taken to such an extreme that it must be reversed abruptly can be a cause. We haven't reversed it abruptly, but we've seen anytime we even slow down these run rates, the problems we have. We mustn't forget right now that we're printing $200 billion a month, not in the United States. $80 billion in Japan, $80 billion in the EU, ECB, and the rest spread out around the world, with a big chunk of it coming from Britain. Both types of explanations are offered in the analysis of the global stagflation of the 90s. It began with a huge rise in oil prices, as I said, but then continued as central banks used excessively stimulative monetary policy to counteract the resulting recession, causing a runaway price and wage spiral. Our shock may have in fact been the dot-com bubble in 2000. There's a possibility that that was really the shock. Let's consider the elements of stagflation in turn to see whether this is a real possibility in the United States or whether in fact we may be closer than we think. Let's look at inflation. According to the Federal Reserve, entrusted with monitoring and managing inflation pressures in the economy, until recently it has been too low and well below the Fed's 2% target, according to them and their numbers. But times are a-changing. Since this time last year, inflation expectation show it has been increasing steadily and rose dramatically with the Trump presidential victory and his proposed economic stimulus programs such as infrastructure and defense. These are expectations that are driving here. But it isn't just expectations that have been increasing, but also actual price tags, some much higher than and larger than the measures that are shown in the CPI measure, and those listening here today certainly recognize with their family requirements. The inflation rate, though, is still low by historical measures if you really look at it or at least believe the government statistics. And so therefore, they've been continuing these policies maybe longer than they should. If we take out adjustments in the government numbers, such as substitutions, hedonics, imputation, and other changes that have been made by the government since the early 80s, we see from Shadow Stats and John Williams' great work that tracks this closely, that in fact, if we have inflation in 1980 terms, we are running at approximately 10% if we went back and again used the 1980 terms of reference for how we calculate inflation. I believe this more closely matches what the average U.S. household would agree with, and I think that this is the issue. This has been going on for quite a while at much higher level that we've been lulled in here, if I can say that. Conclusion, we definitely have inflation. No question about it, and it is worse than the Federal Reserve acknowledges or is actually, might even be actually aware of. We have inflation. Let's talk about unemployment. According to the government narrative, we have low unemployment with concerns about actually a tight labor market. This is pure fabrication or minimally misinformation and distortion of the facts. Again, going back to Shadow Stats and looking at their calculation of unemployment rate using the government statistics and adjusting them back on how we calculated them before using U3 and U6, we see that we're actually running pretty close to possibly a 25% realistic unemployment rate. You say that can't be. Well, I can remember Trump during his campaign when he had 30,000 people in front of him saying, if the unemployment rate was really 5%, we wouldn't have 30,000 people here, we'd have 3. And I thought he nailed right on the head. Should we believe the numbers or do we believe our lying eyes? And it seems that we believe the numbers. We have a labor force participation level at historic low levels with nearly 100 million working age adults not even in the workforce. That begs a lot of questions. And many with jobs not able to get sufficient hours to support a middle class lifestyle. They're cut back on hours because of things like Obamacare, etc., medical coverage. So working multiple jobs for those who are still trying to work. And even those who are working, their wage increases over the last decade haven't come anywhere close to the inflation. So the conclusion is we actually have very high unemployment, and we certainly have complete and massive underutilization of the American workforce. Both of these are contrary to the current beliefs in the system overall. Well, let's talk about demand, another element here. What we have in the U.S. is actually artificial demand rather than stagnant demand, as in the stagflation definition. The difference being that the former temporarily camouflages the latter, but only temporarily. And in reality, we actually have stagnant demand. We have artificial demand, as can be seen in this chart here. Consumer credit is rising rapidly in comparison to disposable income. In other words, we're borrowing increasingly to make ongoing purchases, but those purchases are not increasing. Debt is surging to buy the same amount of stuff, not more. In reality, real economic demand is shrinking and is only presently being artificially supported. What happens when we take the artificial support out? So the conclusion we have here, I believe, is we have weak demand. Even the Federal Reserve is concerned that the demand is not strong enough, specifically within a 70% consumption economy. So, and they've been doing everything they can to bring, through credit, to bring demand forward here for quite a number of years. Let's talk about growth now. And this is the GDP, where it kind of comes together. I don't believe the GDP formula, but we'll use it for sake of this discussion. How can the U.S. current GDP levels seem to be anything other than terribly weak? Thus far, in this first quarter, it's tracking to about 1.8%. The common narrative is that the U.S. is entering a golden age in its economy and that this growth will drive stocks even higher. The reality is that GDP growth has collapsed. The third quarter of last year was the quarter everyone thought signaled a new beginning with growth of 3.5. However, the very next quarter, growth in the fourth quarter collapsed to 1.9%. Put simply, growth is not coming, at least soon enough at all. Even Trump's top economic advisors have admitted that a GDP growth of 3% is unlikely till at least 2018. Conclusion? We actually have historically weak economic growth, and I think most people would simply agree with that. It's hard not to conclude, and when you go through all of these four measurements of stagflation, that we are already living in a period of stagflation with little way out other than praying for a Trumponomic economic miracle. Of course, I've never found prayer as a reliable approach to my investment strategy. I'm not poo-pooing prayer. It's just not something that should be part of your investment strategy. So where does that leave us? And where does that leave us regarding the real potential of a U.S. recession, which I, by the way, think, and have been for a while, that it's rapidly rising? Let's remember that the first-term presidents, historically, has been quite common to see a recession. They typically inherit a mess. And we're long overdue, or even an extended 7 or 8 year cycle without a recession. We haven't outlawed recessions. It's got to be on the horizon, if not very close to it right now. The Trump administration inherited a very leaky ship, no doubt about it. The U.S. economy is taking water fast, and Trumponomics must kick in rapidly, or it may be too late. The worst will be that we have too little too late because of this contentious problem I see unfolding in front of us in Congress. The evidence is actually overwhelming if you take your eye off all the media hype and actually go through the data and look at it. But nobody wants to do that. And they certainly don't want to put it on the media that it will impact sales on the sell side, etc. If you break it down and you really look at the key indicators, which I believe say yes, in previous bull market peaks, we find, as measured as a percentage of change from previous bottoms to current levels, the following. I'm showing here. Core inflation. It rose 11.7 and 7.1% just prior to the last recessions. Currently, core CPI is up 11.1%. GDP growth picked up by 7.5 and 5.1% just prior to the recession. Currently, GDP is up 6.8%. Employment was up from lows by 9.1 and 8.6. Currently, employment is up 19%, or at least it's perceived to be up 19%. Interest last time rose 50.8% and 51% from the lows. Currently, rates are up 87.9%. This is a pretty consistent set of numbers and parallel comparisons here. And you can see in this chart that was prepared by Lance Roberts that they all pretty well line up and are very clear in here. Well, I'm not suggesting that we are about to have the next great market crash tomorrow. The current sensation of déjà vu might just be worth paying attention to here, and I think there's a real possibility of an inflation, of a U.S. recession sometime in the next 12 months. So, in conclusion, as I typically do, I want us to remember not to worry. They'll print their money, and we're only in the early stages of them printing money. And it's tough for markets to collapse for very long while you're printing this level of money. The question becomes what that money will buy. I'd like to take a moment as a reminder, do not trade from any of these slides. As I said earlier, they are for educational and discussion purposes only. Thank you for listening, and until next month, may 2017 be an outstanding investment year for you and your family. Thank you for listening.